Hello and welcome to the Week in Markets. Today we're joined by Matt Henderson, Investment Manager. Today we're going to be talking about Trump's climb down, the positive impact on markets, an update on earnings, and the role of gold as a diversifier in multi-asset portfolios. So Matt, this week we've seen Trump backtracking on a number of fronts.
Yeah.
Firstly on tariffs imposed on China, although that hasn't been confirmed yet, but there's a lot of rumours coming out about Trump lowering those tariffs on China.
Yeah.
And also his calls for the removal of Fed Chair Powell have been retracted, basically. Does this mean that markets are now a constraint on the Trump administration?
Yeah, so thanks, Seb. So I guess from our perspective, we do think that markets are somewhat of a constraint on what the Trump administration can push through. And what's quite a useful case study, I guess, for us to look at is what happened where he first announced, right, we'll put this 90-day pause on those reciprocal tariffs, because what we were noticing was when the US bond treasury yield got towards 5%, that seemed to be the point at which they reacted.
Yeah.
So it's more so that the administration's focused on the bond market than what we're seeing within equity markets, which seems to be the point at which they'll pull back in some of the rhetoric.
Yeah, because initially the equity markets reacted very unfavourably, but the
Yeah.
bond markets reacted favourably,
Yeah.
and they did nothing. And
Yeah.
it was only when the bond market, as you say, started to sell off that they were faced with higher borrowing costs. It has real fiscal consequences for them that the pressure was applied. And
Particularly with one of his main policies that he's looking to push through being tax cuts.
Exactly.
So if
Yeah.
that, as you mentioned, the cost of borrowing pushes higher, that makes that
harder to implement.
Exactly.
Yeah. So we have seen a positive move in markets over the last week or so, but markets are still volatile, but maybe a little bit less so than they were in previous weeks. Do you think that investors are becoming a bit numb to US policy chaos?
Yeah, I think that what we're starting to see is investors kind of get into the mindset of, right, okay, this is maybe what a Trump presidency looks like. There's more headline generating news that's produced from Trump compared to what we're seeing with Biden when he was president. So I think that comes through in a number of measures, as you mentioned. Equity market performance has been better this week. So US equities up about 4%, not accounting for what happens on Friday because the US equity market hasn't opened at time of recording. But when we look at measures of equity market volatility, fixed income volatility, they've all stepped down from that initial tariff spike in volatility that we'd witnessed. I think another important thing to highlight is when we've seen good news come through, those rallies haven't been quite as significant. So when we saw the first 90-day pause tariff come through, we saw the market rally 10. And then, as you mentioned earlier, when we've had the rhetoric of let's pull back on some of the China tariffs, the market's only rallied 5. So I think markets are starting to become a bit more used to, this is maybe what President Trump will be like compared to President Biden.
Yeah. And behind the tariff headlines, there's also an ongoing correction in the tech sector.
Yeah.
And how big do you think the impact of this could be on the overall market? Do you think this continues? And what's the kind of magnitude of this?
Yeah, so coming into the year, I guess the backdrop for US tech was there's maybe some headwinds there from what we'd seen from China with their own AI, where investors start to question, actually, what is the long run return on equity from all these tech companies spending on things like AI when, as we know, China produced something similar at a fraction of the price. So there was some doubts and question marks over tech. So if we look at things like the S&P 500, we know it's very tech dominated and tech heavy. Those returns had been lower than what an equally weighted version of that index would be. But what's kind of been a headwind or has stalled that shift that we'd seen has been the tariffs. So if we look at the performance of the S&P 500 versus its equally weighted version, through the tariffs, they've been thereabouts as the same type of performance. So I think at least what we believe here at True Potential is that undertone of actually question marks around tech probably still persists, but it's been somewhat masked by the volatility of tariffs.
And there's a big difference between the impact on the overall market of a correction in one sector and a systemic financial crisis. So we've looked at the difference between the tech bubble unwind in 2000 and the 2008 financial crisis. And in 2000, there were places to hide in the market. There were sectors of the market, certain styles of the market that did okay. Whereas in 2008, everything sold off. And I think we'd probably characterise it as being more like 2000 than 2008.
Yeah, and I think that probably comes through in terms of what we're seeing, in terms of what the market's pricing for earnings growth. So back to your example of 2008, earnings were expected just to be negative, whereas actually what we've seen so far in markets is earnings growth rates for this year were probably at the start about 15%. With tariffs, we've seen that drop to about 10. So it's not actually that earnings are going to be negative and be lower. It's just the expected amount is slightly lower, but it's still a positive number. So that highlights your point. Within a rotation, there's areas that can still do well whilst tech underperforms.
And then finally, we touched earlier on the performance of US bonds, US treasuries in this period of market turbulence. And they haven't overall been acting as a good diversifier for equities. But and probably that's because the Trump administration is seeking to kind of undermine the role of the dollar as a reserve currency, etc. But what's taken its place as a good diversifier has been gold. Anything to add on gold?
Yeah, I guess what we've seen from here at True Potential with our manager partners, as you mentioned, some of those managers have actually looked to shift from fixed income assets into gold. And I guess what's been good and useful for us to observe as multi-asset investors is that actually gold's been a very good diversifier for equities over this period. So when we've seen weaker performance from equities, gold's actually worked as a diversifier, but then that has also worked in the opposite way. So gold's been a little bit weaker over the past week, say maybe 2 weeks, but actually we've seen really good performance from equities. So I guess our takeaway is that gold has actually worked really well as a diversifier in our portfolios.
Yeah, and I suppose also, so we've become, as investors, less reliant on US bonds as a diversifier for equities, but other bond markets have performed quite well. So German bond markets, for example, and even UK gilts have performed quite well in the period of market turbulence.
And that probably speaks to the differences that we could see in inflation in those regions where tariffs and immigration policy in the US is likely to be inflationary, whereas in Europe, we've got lower oil prices, probably goods from China end up in there, so there's more deflationary forces in those markets.
And a green light for those central banks to cut rates more aggressively. Okay, I think that's it for this week. Thank you for listening.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.